Welcome back to the channel where we cut through the noise and break down what's really moving market. It's the last week market overview and a lot just happened. Israel and Iran supposedly hit pause on their conflict, oil prices tumbled, Fed officials are sending inflation warnings, and the US dollar is in free fall. But if you think this means smooth sailing ahead, think again. So first, the Israel-Iran conflict. On June 24th, the news broke that a complete and total ceasefire was declared. That's what Trump said, except it wasn't true. Iran's foreign minister Abbas Araghchi immediately denied it. There was no official agreement, just a vague promise that each side would stop shooting for 12 hours. Iran first, then Israel. This wasn't a peace treaty. This wasn't even a truce, it was a pause. And surprise, both sides accused each other of breaking it within hours. But what did markets do? They treated it like peace in our time. Oil prices, which had spiked due to threats near the Strait of Hormuz, dropped fast. West Texas Intermediate fell 3.2%, Brent crude dropped 3.4%, investors exhaled. Stocks rallied, S&P 500 up 0.87%, Nasdaq up 1.1%. This is what we call a sentiment rally. People wanted to believe the worst was over. But here's the problem. Nothing fundamental changed. The Strait of Hormuz is still one bad headline away from chaos. Goldman Sachs warned, if conflict resumes, oil could shoot past $100 per barrel. So while the charts look calm, the geopolitical risk is still red hot. This isn't peace, it's a headline pause. Stay alert. Next up, Thomas Barkin, president of the Richmond Fed, gave us some tough love. He said the quiet part out loud. Tariffs are back, and this time they're going to hit your wallet. Previous rounds of tariffs didn't always lead to big price hikes, but this time, businesses are prepared. They're going to pass those extra costs directly to you, the consumer. That means electronics, clothing, even cars. Get ready for sticker shock. Now, Barkin doesn't expect a massive COVID-style inflation spike, but he did say price increases are very likely in the coming months. And that's a big deal because it throws cold water on all the rate cut optimism. Right now, the Fed is keeping rates steady between 4.25% and 4.5%. They're in wait-and-see mode. Barkin said the economy looks solid. Jobs are strong, inflation has cooled, but if tariffs push prices up, the Fed might not just delay cuts, they could raise rates again. That's important for households with loans, businesses relying on imports, investors hoping for cheaper money. This throws July cuts into doubt. Some now expect a move in September, but only if inflation behaves. And while some Fed voices like Christopher Waller and Michelle Baumann are more optimistic, Barkin's tone was cautionary. If tariffs push prices up, rate cuts are no longer a given. The market's dream of cheap money might stay a dream for now. And now to the US dollar, which is in trouble. On June 26, the dollar hit its lowest point in over 3 years, down more than 10% for the year. That's the worst 6-month slide since the 1970s. Why? One word, politics. Trump blasted Fed Chair Jerome Powell, calling him terrible and implying he might fire him early. This scared markets. Why? Because it suggests the Fed might come under political pressure to cut rates faster than it wants to. Suddenly, investors started pricing in 125 to 175 basis points of cuts by early 2026, way above what the Fed is projecting. That divergence tanked the dollar. In response, tech stocks surged, gold rallied, the euro, yen, and Swiss franc all gained sharply. But here's the risk. This rally is based on hope that the Fed caves to political pressure. If Powell stands firm and doesn't cut, those investors are overexposed. We call that a pain trade, when everyone's on the wrong side of a bet. Also, a weak dollar has ripple effect. Imported goods get pricier, travel abroad becomes more expensive. Exporters win, importers lose. And above all, the credibility of the Federal Reserve is on the line. This dollar drop isn't just about interest rates. It's about whether markets believe the Fed is still independent. So, here's where we stand. The Israel-Iran conflict is still smoldering. Don't let the word ceasefire fool you. Tariffs are sneaking inflation back in through the side door, and the Fed might respond with higher rates. And the US dollar, it's caught in the crossfire between politics and policy. Markets are green, but they're built on hope, not stability. So what should you do? Stay cautious. Watch inflation, watch the Fed, and above all, don't assume the summer will stay quiet. That's all for today. Stay smart, stay skeptical. Thank you very much for watching, and let's build the bridges and not burn them. Goodbye.